Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst stock. Today we're looking at Opendoor Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath. And hey, before we jump in, the link for our VIP Algos is right below in the description, so definitely check that out if you want to elevate your research.
Absolutely. And this is quite the analysis we have today.
It really is. Imagine stumbling across a company whose stock has completely collapsed. I mean, we're talking down a staggering 64% from its recent peak.
Yeah, which usually looks like a disaster.
Right. Wall Street analysts are aggressively sounding the alarm, short sellers are circling, and the whole macroeconomic environment looks like a perfect storm designed to just crush this specific industry. So your first instinct is probably to just run the other way.
I mean, it looks like a financial hazardous materials warning. The surface level data completely points to a sinking ship.
But then you look a little bit closer at the recent filings. You start noticing something completely counterintuitive happening beneath all that noise.
The insider buying.
Exactly. The executives who are actually running the company, the ones seeing the daily operations, they are quietly buying up shares, and not just, a token amount to keep up appearances for the board.
We're talking hundreds of thousands of shares in massive cluster buys.
Which creates this really fascinating divergence, right? You have utter panic on the outside, met with intense checkbook-driven conviction on the inside.
It really is the ultimate puzzle. To understand Opendoor, we have to look past those flashing red headlines and dissect the actual mechanics of their business model. Because when you see a disconnect this severe, the truth is usually hiding in the raw unit economics.
Let's start right there with the underlying engine. Before we even touch the stock chart or the macro headwinds, we need to establish how their product actually works in the real world.
Right, because if the core product is broken, the stock price doesn't matter.
Exactly. So for anyone who hasn't bought or sold a home recently, Opendoor's primary moat is the iBuyer model. It's essentially an algorithmic house-flipping robot.
And to appreciate why that matters, you have to remember how notoriously awful the traditional real estate transaction is. It is so illiquid.
Full of friction.
Right. Selling a house typically involves, repairing the property, staging the living room, leaving every weekend for endless showings.
Oh, the weekend showings are the worst.
They are. And then after weeks of negotiation, you just have to cross your fingers that the buyer's mortgage financing doesn't completely fall apart at the closing table.
So Opendoor steps into that nightmare and offers an alternative. They use this proprietary pricing algorithm to just give you a cash offer almost instantly.
But it's important to note, this isn't just some basic online Zestimate.
No. Their algorithm digests hyperlocal data. It looks at recent neighborhood comps, the specific cost of replacing a roof in your zip code, and it even factors in the liquidity risk of holding that specific property.
And because of their scale, they have a major edge over competitors like OfferPad. The more houses Opendoor processes, the more localized data feeds back into their system.
Which makes the algorithm increasingly accurate, right?
Exactly. It creates this continuous feedback loop. It lets them tighten their margins and offer more competitive cash payouts to sellers.
So the technology is sleek. It solves a massive pain point. As long as houses are moving quickly from the seller onto their algorithmic conveyor belt and off to a new buyer, the system hums along.
But, and this is a big but, we have to look at the financial reality. Because right now, that conveyor belt seems to have hit a solid brick wall.
Yeah, the bleeding is real. Their trailing 12-month revenue is down 23.16% year over year. And the net margins are sitting at a brutal negative 35.25%.
Those numbers represent a severe contraction. A negative 35% net margin means that for every $100 Opendoor brings in, they were losing $35 after all expenses, taxes, and debt payments are factored in.
That is heavy. But tucked inside that grim income statement is probably the vital silver lining of this whole talk. Their gross margin has remained largely intact at 8.2%.
Yes, and we really need to highlight why that matters.
Well, wait, let me push back for a second, though. Because if the net margins are a staggering negative 35%, is it possible that an 8.2% gross margin is just the drop in the bucket? I mean, how long can a tech company survive being weighed down before the cash just completely runs out?
That is the exact existential question Wall Street is asking right now. But we need to separate the gross margin from the net margin to see why the insiders are so optimistic.
Okay, break that down for us.
So gross margin measures the core unit economics. When Opendoor buys a single house, puts it on that conveyor belt, and sells it to a new buyer, they are making an 8.2% profit on that specific transaction.
Oh, wow. So the algorithm is still pricing the homes correctly.
Exactly. The core buying and selling machine works. It is fundamentally profitable on a per-house basis today.
So if the core transaction is profitable, where is all the money bleeding out to create that massive negative net margin?
It's bleeding out through the ghosts of the past, basically. That net loss reflects historical fixed cost burdens and legacy inventory write-downs.
You mean the houses they bought right before the market turned?
Yes. We're talking about homes they acquired back in 2024 and early 2025, right before the housing market rapidly cooled off. They were caught holding thousands of properties that just immediately lost value.
And to get those houses off the books, they had to slash prices and take massive losses.
Right. So the current negative net margin isn't a failure of their algorithm today. It is the very expensive process of clearing out bad inventory from yesterday.
Which explains why the market is heavily discounting their assets right now. If you look at the valuation metrics, their price-to-sales ratio is sitting at 0.9383.
Which is wild for a tech-adjacent company.
It is. In plain English, investors are paying less than a single dollar for every dollar of revenue Opendoor generates. It's distress pricing.
And you see it in the price-to-book ratio, too, which is at 3.8732, because those legacy write-downs eroded their underlying book value, their actual equity. The stock trades at a high multiple to its book value, even after the massive share price drop.
The market is entirely focused on the heavy bags they are carrying from the past, just completely ignoring that the new inventory is profitable.
And you can see the exact moment the market decided to capitulate on this when you look at the chart.
Oh man, the price action on this stock is just violent. Right now it's trading at $3.84.5, and it just suffered a massive 12.21% drop in a single day.
A gap down of that magnitude is just, well, it paints a very bleak picture on the daily chart.
But here is where it gets really interesting. If you zoom out, the whiplash is intense. It's down 64.6% from its September 2025 high of $10.87.
But it's still well above its 52-week low of $1.70.
Right, so you have a positive 52-week return of about 52%, which is completely stalling out into a negative 26-week return of negative 34%.
The volatility is extreme, but the most critical detail here isn't the price depreciation, it's the volume.
The volume surge is crazy.
It really is. The 10-day average trading volume is running at 1.96 times the 3-month average.
Basically double the normal amount of shares changing hands. But wait, if I'm looking at this and I see volume nearly double on a day the stock drops 12%, my instinct is to run away. Why on earth would anyone view a mass exodus as a potential bottom?
What's fascinating here is the concept of exhaustion selling, or a capitulation event.
Okay, explain that.
Well, think about the psychology of loss aversion. When a stock slowly bleeds out over 6 months, retail investors tend to hold on, right? They just hope it bounces back so they can break even.
Yeah, no one wants to realize a massive loss.
Exactly. But eventually, the pain becomes unbearable. A sharp 12% drop acts as a breaking point. The last of the weak hands finally panic, throw in the towel, and just sell their shares at market price.
So the selling pressure literally exhausts itself.
Yes, there's almost no one left holding the stock who wants to sell. But here's the key. For every seller, there must be a buyer.
Right.
When volume explodes at the absolute bottom of a downtrend on a violently red day, it usually means institutional money or algorithmic trading programs are stepping in. They are absorbing all those panic-sold shares at a massive discount.
So
Wall Street's narrative is definitively bearish right now. There's a recent short report questioning their path to profitability, and you have analysts like Keefe, Bruyette, and Woods maintaining an underperform rating.
yeah, they slightly raised their price target to $2.65, but
Putting a $2 target on a stock near $4 is effectively predicting another 30% bleed.
right. So the institutions are mostly staying away. We do see some under-the-radar retail interest, though, right? It popped up on the Benzinga Stock Whisper Index.
Which tracks stocks seeing quiet, increased monitoring by individual investors. But the ultimate bullish signal, the thing you cannot ignore, is the insider cluster buying.
Over the last 90 days, insiders made 7 buy transactions versus only 2 sells. They scooped up a net 235,654 shares.
And the management sentiment price ratio, the MSPR, is strongly positive at 72.41.
That is high.
If we connect this to the bigger picture, it's incredibly telling. Analysts are trading based on current cash burn and the macroeconomic lag, looking at the trailing data.
But the insiders who actually see the daily operational turnaround, who see those 8.2% gross margins on the new houses, they are betting heavily on their own survival. But let me ask you this, as a skeptic, are we sure these insiders aren't just trying to project false confidence? Could this just be, a 250,000 share PR stunt to catch a falling knife?
I mean, executives generally do not light millions of their own personal dollars on fire just for a quick PR stunt. Cluster buying of this specific magnitude across multiple executives usually indicates a genuine, calculated belief that the market has severely mispriced the company.
They believe the turnaround is already happening.
Yes, the market just hasn't seen the final numbers yet.
So to resolve this standoff between the bearish analysts and the bullish insiders, we have to look at the external forces, the macro tug-of-war.
Opendoor's immediate proving ground is going to be the upcoming August 2026 earnings report. The market needs to see that revenue stabilization and margin expansion.
But honestly, even if they execute perfectly, they are essentially at the mercy of the Federal Reserve.
They really are.
Let's lay out the bear case first. The higher for longer interest rate environment, and this is factual, neutral data here. We're looking at global geopolitics. U.S.-Iran conflicts are currently pushing oil above $100 a barrel.
Yeah, and when oil stays above $100 a barrel, transportation costs skyrocket, which keeps inflation elevated across the board.
And as long as inflation remains high, the Fed delays cutting interest rates,
Which keeps mortgage rates hovering around 7 or 8%, and that creates a massive lock-in effect.
because if you have a 3% mortgage from a few years ago, you are not selling your house to take on a new 7% mortgage.
Exactly, you just stay put. Housing inventory dries up, transaction volume plummets, and Opendoor's algorithm just has no houses to process.
It's like Opendoor is like a state-of-the-art sailboat. The technology is perfect, the design is flawless, but it absolutely doesn't matter if the Fed refuses to give them any wind.
That is a perfect analogy. A company cannot capture an 8.2% gross margin if there are no transactions taking place.
So if oil stays above 100 and the Fed keeps rates frozen for the next 2 years, does this algorithm just eventually run out of cash? I mean, are these risks already priced into that 64% drop, or is zero still on the table?
Zero is always on the table for cash-burning tech companies in a high-rate environment. But that massive 64% drop suggests the market has heavily priced in this worst-case scenario, which brings us to the bull case catalyst.
The rumor mill regarding potential Fed rate cuts.
Right. We are seeing slowing economic data elsewhere. If the broader economy cools down enough to force the Federal Reserve to pivot and cut rates, it acts as a massive immediate catalyst.
Because Opendoor has a huge beta.
A beta of 3.63.
That is massive volatility.
It means this stock moves more than 3.5 times as fast as the broader market. Any pivot by the Fed or a sector rotation back into risk assets would disproportionately send this stock soaring by unlocking housing turnover.
So bringing it all together into a final synthesis, what is the actual takeaway for you, the listener, today?
Opendoor is a 6 out of 10 bullish scored turnaround play. It is high risk, high reward.
It offers asymmetric upside if you believe the insiders and the gross margins, but it requires an iron stomach to wait out the Federal Reserve.
Absolutely. It's a masterclass in weighing operational distress against massive insider confidence.
And before we wrap up, I just want to leave you with a lingering thought. Step away from the stock price for a second. If algorithms and massive tech companies like Opendoor eventually succeed in removing all the friction from buying and selling houses.
If a house becomes as easy to trade as a stock on an app,
Right. How will that change the very nature of our neighborhoods? If we remove the friction of moving, does the American dream of putting down roots fundamentally change? It's definitely something to mull over the next time you look at a real estate listing.
a really profound question to end on.
For sure. Thanks for joining us on Smart Wealth with Joshua. And remember, the link to our VIP Algos is down below in the description. Don't forget to subscribe, like, and comment, and we will catch you on the next one.